Good afternoon and welcome to the second quarter capital market review. This is actually a re-recording that I'm doing a few weeks after the live broadcast. We had a little bit of an audio issue, so we thought we would re-record today. We're going to pretend that some of the events that occurred here the last week or so in the market didn't, as the information for the capital market review coincides with what was present and active and available during that period of time. Nonetheless, we will talk a little bit about market pullback and valuations as well. As I do every year, or actually every quarter, I identify a title or a theme for the capital market review. This quarter, I would say great quarter, but getting a little bumpy. Bumpy from the point of view of a bit more volatile. Things are not quite as smooth as they may have been last year when there was hardly a pullback at all. As always, we do these to get a better understanding of where we are presently. We dissect the several components of the economy. We look at growth, we look at job creation, we look at profits. We'll talk a little bit about inflation and also interest rates. Our attempt is to understand better where we are presently and also where we're heading. The real reason for this is we would like to be able to identify if in fact components of the economy are beginning to break down so as to perhaps discuss being a bit more defensive with clients, or in the case of a recession, see green shoots and opportunities for growth as we're digging out of a recession to become a bit more growth-oriented. At this point, as we'll see in a few moments, we're much the same. The economy is still growing, muddling through. We want to keep ourselves balanced, we want to keep ourselves diversified, and we want to keep ourselves invested. And by pushing this kind of content out, a better informed client is a better prepared client. So that's also one of our goals and objectives. As with every quarter, I break the presentation down into several themes. This quarter we have 5 themes. The U.S. economy, we're going to talk about how we had a really horrible first quarter. We're seeing a great rebound from that horrible first quarter. And longer term, it looks like the economy is kind of setting itself up for a bit better growth. We're going to talk about the Federal Reserve and interest rates and the problems that the Fed will face as they start to reverse current interest rate position. We're going to talk about the U.S. Equity markets, and in particular the fact that we remain cautiously overweight. We think equities are still a good place to be, but we recognize that gains from this point will be a bit less robust. And we're also several years now into this recovery without a sizable pullback or pause. The fourth item will be international markets and the international potential thereof, both from the standpoint of emerging and developed. Both fiscal and secular stories offer perhaps greater opportunity than the U.S. market does presently. And the very last thing is adjustments that we might want to make as we move toward full employment. And the reason for that is as we move toward full employment, the Federal Reserve is kind of running out of running room. There's less things that they can do. At some point, they're going to have to start raising interest rates, and that may have an impact on the market. So before we begin, let's just chat for a few minutes about where we are. The S&P chart, going back to 1989, kind of shows several mountain peaks and a very significant rally since 2009. In fact, this period, this level right in here, from like here to here, this is mostly 2013, and you can see literally it's straight up. Let's also notice that we're 190% from our previous high, and we've surpassed the previous high water mark by about 400 or so points. So that's pretty significant. Not to say that the market can't continue to go higher, but I doubt it will go significantly higher without some type of significant pullback, which is normal and healthy with respect to the markets. Last quarter, everything did well. second quarter of the year. As you can see along this chart here, every single subsector of the S&P 500 was positive. That's also unique. And the returns were robust. Even the worst performing category last quarter, financials, had a positive 2.3, would have annualized out at a very attractive rate. The best was energy, and utilities did well as well. Interest rates actually ticked down. If you look at the chart right here, you can see that little blue line, which is nominal rates. Those are the real regular rates in the market, not adjusted for inflation, actually ticked down a bit. That was unusual. It was unexpected, and it probably had everything to do with the very weak GDP growth rate that we had first quarter of the year. In fact, as you'll see on one of the upcoming slides, GDP for the first quarter actually slipped, mostly weather related, but it caused some concern as to whether that would spill over into the second, third quarter and balance of the year. It doesn't look like it is, but as a result, yields came down, prices went up, not expected. As far as flows going in, where investors are making bets, this year at least, we've seen bets in domestic equity, in world equities, in taxable bonds, as well as emerging bonds. Essentially, stocks and bonds receive positive flow. Now, that has not always been the case. In fact, there's been very little positive flow going into the equity markets. This year, year to date, about $10 billion, last year $18 billion, and the previous years, the previous 4 years that represented most of that huge bull market, there was actually negative outflow. Bonds have had huge positive outflow in spite of the fact that interest rates were low. They had a bit of negative outflow last year and a bit of positive inflow this year because bonds improved a bit in value as a result of the lowering of interest rates. We think that's kind of a fluke. We think that's somewhat temporary. Let's start with the themes, and let's look at our U.S. economy. Looking at this chart right here and looking at these two lines, this dashed line and this dashed line, you'll notice the current expansion at 2.1% compared to an average expansion of over or just at 3%. So we're expanding at about a third less speed than a market average. And that's important to recognize, because when we hear data points saying we're 5 or 6 years into a recovery, recoveries don't last much longer than that. The expectation is this recovery potentially could last a bit longer, only because the recovery has been much, much less robust. It is slower than expected. The bad first quarter print probably should be asterisk. This drop that you see right here, the fact that the first quarter, quarter over quarter, was a minus 2.9%, that should probably be highlighted or asterisked just because a lot of that was weather related and it was one-off. People are expecting second quarter numbers to be growing at somewhere closer to 2.5% and probably closer to 3% for the second half of the year. And the reason for that is a lot of positive economic activity. Light vehicle sales, cars and trucks, very strong growth. Housing data looks strong and generally uptrending as well. Now, there will be periods where there will be some sell-off, as there was in the last quarter of last year, early first quarter of this year, but then a fairly substantial snap back. All of this will really help the markets in the near term, and that's also one of the reasons why focus on second half of the year has been so positive. Just in my little world, I've seen a number of new home construction projects being started, first time in 4 or 5 years, and it's very, very difficult to get into a restaurant, even here in Fenton, Michigan. Normally, that's a sign that the economy is performing well and people are less concerned about discretionary spend. So those are good. A couple of problems in the long term. One of the big problems has to do with productivity and capital spending. Let's look at this chart right here. Real capital stock growth. That's capital spending. That's corporations investing in equipment, providing tools for the workforce. We've had very anemic growth. And in fact, the level of CapEx spending today has not gotten anywhere near where CapEx spending was in 2007. That's a problem. That will hurt productivity. That could make us a bit less competitive. Now let's look at the chart on the right-hand side, productivity. Look at the sell-off or slowdown in productivity, 1 year versus the next, and compare that productivity to the surge that we had right after the recession, and for that matter, even where we were in 2007. Productivity numbers are very weak, and that's output per man hour. Two things are driving that. One is the reduction in the labor force. The sheer number of folks who are turning 65 and are effectively retiring, exiting the labor force, and kind of killing labor force growth. Just as we're hiring new people, we're exiting others. We'll be lucky from an economic growth formula point of view to see much more than 2% growth over the long term without a huge amount of immigration reform. The other thing that's important to look at here is we're becoming less productive. We're not arming our employees with the right kind of tools. Think about it this way. If we had a factory back in 2007 before the recession, fully running, fully tooled up, employees at each station running things, then because of the recession there were major cutbacks. Many of the folks retired out, left the workforce, were downsized. The factory was still operating, but a lot of tools idle. And then the hiring began, and we started to hire people who would stand in front of the idled tools. Huge upswing in productivity. Many of these tools have been bought and paid for. Now we have that many more people working in front of productive pieces of equipment. We're now at a point where all the tools that we had and were bought in many cases 6, 7, 8, 9, 10 years ago are running and operating, but we're not buying more tools. We're not expanding productivity, and that could be a long problem. Not throwing in the towel, those problems generally have to be fixed with fiscal policy, structural help, with policy changes in immigration, entitlements, the tax code, allowing corporations, as an example, to bring back dollars that they've earned elsewhere back into the U.S. without being double taxed would be a huge boost to productivity. Let's talk about the second point, Federal Reserve and interest rates. If we look at the unemployment rate, we'll see that it is now 6.3%, down from nearly 10%. And at this point, we are fully recovered from the standpoint of jobs. We've created 9.4 million jobs compared to the 8.8 million jobs lost. Granted, many of those jobs are hiring people that are underutilizing their capability, but we've gained back effectively what we've lost. That's a positive sign. Inflation has ticked up a little bit. At 1.9 is certainly higher than it was the quarter before. This gray line that we see here effectively has ticked up a bit. That's an upswing in core inflation. And one of the reasons for that, one of the biggest reasons, is right here. 41.4% of the unemployment component for core is housing. And housing demand has increased. Rents have effectively increased. And the tight housing market has been effectively driving up rents, and rent or housing equivalents, which is a fancy way of saying rents, affect core inflation. We think the problem here is that the Federal Reserve is maybe a bit too conservative. We think they are discounting some economic growth in the formula. And if we don't see an increase in capital spending, then the Federal Reserve has little rope to work with, because they haven't raised rates. Rates are very low, and they really can't bring rates down much to stimulate a slowing economy. So we will probably see much of this being dealt with through higher core inflation. This chart, just a couple things that I want to share with you, and most is in this lower box here. These are the Federal Reserve economic forecasts and projections. And as I said, I think the Fed's projections are a bit too conservative. Look at this line here, which deals with the unemployment rate. The Fed effectively believes that unemployment by the end of the year will be 6.1. Actually, it is 6.1, effective the end of June. They're calling for that at the end of the year. By the end of 2016, they expect the unemployment rate to be 5.3. We may actually get there much sooner. And if that's the case, then real inflation will kick up a bit quicker than the Federal Reserve anticipates. Normal rates could move quite a bit higher. And as the Federal Reserve is getting rid of quantitative easing at the end of October, longer-term rates might be able to move up a bit more quickly, as well as the Fed has kept the cap or artificially suppressed these rates. It's very important to look at fixed income and the portfolios from the standpoint of, well, what areas could be problematic if in fact interest rates do start to go up. Because if the economy is growing, a healthy yield curve is upward trending, and right now the yield curve is flattish because it's artificially suppressed. And we can see the 50-year interest rate chart. Interest rates peaked at 15.8% back in 1981, and they got as low as back in 2012, I believe. You can see the dip down. They were much higher at the beginning of the year than they are presently. We think, as I said before, that's a kind of a miscue. We don't expect that trend to continue. I think it had everything to do with weak economic data from the first quarter of the year. The Federal Reserve is doing an incredible job about artificially keeping rates low. And the reason rates haven't gone up already, in spite of the fact that everybody expects rates to go up, is because the Fed has had the ability to keep rates low. And they've done that simply through a matter of supply and demand. The supply of bonds is created by the Federal Reserve, or I should say the budget deficit. The deficit is effectively being funded by borrowing. And right now, the borrowing to satisfy a 2.8% negative deficit is, as you can see, significantly less than it was in 2009 and 2010. In fact, the budget deficit this year is expected to be $492 billion. It was over $1 trillion just a few years ago. So this has reduced the number of bonds that need to be issued. So the supply for bonds have dropped. If the supplies drop and demand stays pretty constant, prices go up and yield goes down. The Federal Reserve has effectively bought $500 billion worth of bonds last year. Governments buy half the bonds we issue. We're buying about 20% of the bonds. Foreigners have bought 32%, and that's of all bonds being issued, all outstanding bonds. The bulk of those bonds recently have been bought by the Federal Reserve. So the demand has been artificially created. The Fed's purchasing these bonds to keep demand high and yield low. At some point, when the Fed stops buying bonds, quantitative easing stops, interest rates will probably need to rise a bit to entice others to buy bonds, because our deficit will still require us to issue those bonds. This will probably cause rates in the long term to begin to rise. Presently, interest rates have really moved quite a bit. This is a great chart. This shows just the base rate on bond return, just the movement in bond price. The dark gray bars represent the price movement in U.S. Treasury issues last year, and they were all negative. 30-year bonds lost 20% of their value. 10-year bonds lost nearly 10% of their value. This year, light blue, to a large degree, they've actually had an increase in price. And the reason had a lot to do with yield. Yield has come down. This chart shows the coupon rate, or the yield, on new issues. You can see where yields expanded, the dark gray. They were higher last year than the light blue today. That had everything to do with the weak first quarter. That probably won't continue going forward. Let's talk about the U.S. equity markets. Pretty robust. Good profit growth. Analysts suggest that profits for the year could exceed $29.14. That represents about a 10% increase in earnings from a year ago. Earnings growth is still very good, and that should help continue with some degree of market growth. Valuations are not bad. I would have to say there are no bargains. For the most part, they're fully valued. If you look at most normal analytical data points, PE, dividend yield, PEG rate, they're equal to or slightly higher than average. The 25-year average, 15.5 times earnings, currently 15.6. Shiller PE, 25.1 on average, 25.6. Dividend yield, 2.1 on average, 1.9. And then the last point, PEG rate, which is price to earnings to growth, 1.4 to 1.5. So things are fully valued, no real bargains. However, if you look at S&P earnings yield, that is the earnings of the S&P compared to the BAA bond yield or investment grade bond yield, earnings are 6.4% compared to, so that's the inverse, that's earnings divided by S&P price compared to the bond yield of 4.7. Historically, it's less than that. The earnings yield, which is this green line, should effectively be below, or has been historically below, the bond yield line. Today, it's not quite as gappy as it was, and the gaps are narrowing a bit, but to a large degree, it's still positive, and that's a good sign. Things are not ridiculously or problematically overpriced. Let's look at the multiples. There's not a lot here to really talk too terribly much about. Growth versus value, which is what we're seeing here in terms of these lines. They look very, very similar. There's no cheap sector. It's not like value is better than growth or growth is better than value. Both seem to be doing well. International markets are improving. I like this chart. This is a great chart. It's kind of like a heat map. It's the Purchase Managers Report. Green is good, red is bad. If you look through June, this is Europe. This is the U.S. right here at the top. That dark green, 57.3. You'll see most of Europe is now greenish. If we go out a couple of quarters, less greenish, less greenish. We've been in that green zone for quite some time when Europe clearly was not. Red is really bad. Effectively, anything over 50 means positive economic activity. Anything less than 50 is a contraction of some sort. So Europe across the board is doing fairly well. Greece is kind of flatline, and France is slipped a bit. That has a lot to do with fiscal policy. But for the most part, Europe has certainly been improving and is just recently improving. Interest rates also have been falling worldwide. This chart will show that. You'll see the peak. Europe is a bit different, and they've had different trials and tribulations. We went through the Great Recession, spilled over there. They went through the Great Recession, and as we were coming out of the recession here, they went into a sovereign debt issue. That's where there was a huge spike in interest rates in 2011. I mean, our rates had been coming down significantly since 2008 and 2007, but their rates actually started to go back up. There were concerns over countries and banks not being able to handle their debt. So they had two big shocks to the system, one after the other. But you're beginning to see those interest rates are down. And in some countries, like Ireland, their yields are actually cheaper than they are here in the U.S., which is really quite interesting. You can right now lend or receive money, receive interest in UK and in Ireland at actually lower rates than what we would have available here in the States. This is also going to help in two other ways. One, because we're through the sovereign debt issue, many of these countries have kind of removed their austerity programs. So we're beginning to see both corporate and consumer spending. And the other thing is most of these companies, or I'm sorry, countries are getting out of the way. There's less government fiscal drag. Look at all the gray bars, which represent percentage of fiscal drag. That's structural deficits from 2010 to 2013, pretty much during this period of time here, compared to where we are today, which is the purple. Much less drag. So Europe is certainly ready for some degree of growth. Their unemployment rates are starting to come down. Clearly not where they are here in the U.S., but they are beginning to start coming down and trending a bit lower, which is really very helpful. And their unemployment rates are also still low and coming down. Again, in terms of the recovery, they're several years behind us. We just talked about Europe. Let's talk about the emerging markets for a minute. The emerging markets really are pretty attractive for a couple of reasons. One, they have a younger population, and the other is they spend a greater percentage of their GDP on structural investments. The U.S., compared to developed nations, is actually in pretty good shape. Percentage of population under 20, we have 26%. That's greater than Canada, the UK, Germany. Some of that is because of our immigration policy. And our investment in infrastructure is 20%, which is only exceeded by Canada and Japan. Germany's 17, the UK's 14. Emerging markets, they spend 26, 35, 22, 14, 48% on investment. And under age 20, 22%, 38%, 33%, 38% in Mexico. So that really helps. Their labor force effectively can grow much faster, much quicker because of the demographics. Also, from a stock perspective, emerging markets, which is this light blue line here, is showing higher earnings per share than either the S&P or Europe, and they're showing lower PE multiples here compared to Europe or the US. Europe is cheaper than the US. We mentioned that before. Emerging markets is much cheaper still. What happens as we move toward full employment? As we move toward full employment and interest rates do start to go up, there will probably need to be somewhat of a shift in portfolios, at least on the fringes. We've relied for 30-some years on bonds as a way of reducing stock market risk. And bonds also, in addition to de-risking the portfolio, provided a return opportunity because interest rates fell and bonds went up in value. Going forward, it will still provide the opportunity to de-risk and remove risk from the equity side of the equation. But we're not expecting bonds to contribute much, at least not the next 4 or 5 years, to return. So this middle section of the portfolio, which has often been overlooked, the alternative space, commodities, natural resources, real estate, these are areas that we might want to take a closer look at. Not only can they provide return that is different than stock equity and different than interest rate sensitive bonds, they can also provide some degree of a hedge against inflation, which I also think is of some importance. Real estate, the yields on real estate investments. REITs. REITs are real estate investment trusts. They can be had in a number of varieties, other in investment types, but real estate in general, cap rate, which is the investment rate divided by the rental return, is generally higher than bonds. And real estate generally, as you can see here, here's cap rate differences, cap rate, real estate yield, treasury, effectively better return. And they don't zig and zag effectively the same way. And that's what adding those things to the portfolio does. It further spreads out the returns, it further de-risks the portfolio, and you can see in terms of performance, here REITs have outperformed the S&P year to date. There were several years where REITs outperformed the S&P. There isn't one area of the market which performs consistently, regularly, so a more balanced approach which has multiple assets, multiple sectors, and global in scope tends to provide a much smoother ride without the feast and famine of trying to chase high performance. So with that in mind, I'd like to open up to questions. I also want to remind everybody that we do offer a second opinion service. If you have loved ones, friends, family, colleagues that would like to just get a second opinion on what they're presently doing and how well they're marching toward achieving their goals, that's what we want to be able to do. In closing, I also want to remind you that we're kind of right in the middle of this market seasonality period. It doesn't happen always. It happens more often than not. And that the best period of time for the market is usually in the fall and through the first quarter, and the weakest period of time is the 6 months that typically begins in May. And we're a bit overdue for a pullback. I mentioned that before. Historically, the S&P 500 has enjoyed a 14.4% annual inter-year drop-off over the last 35 years, and we are now entering the third year without a 10% pullback. So to have some kind of a pullback of some measurable note would not be out of the question, but as we saw earlier, the economy is still plugging along, and there isn't any concern that we're rolling over into a recession. So that is one of the reasons we're marginally optimistic about the equity market in particular. And I'd like you to just hang on the line for a few more minutes as I give everybody plenty of opportunity to read all of the definitions, risks, and disclosures. Many of the slides that we used today were provided by J.P. Morgan, and these are their disclosure pages. You'll see every single index, every single investment that was referenced on a slide is defined here for each and every one of you. We'll also describe and disclose that the opinions are those of myself and not that of Raymond James, or for that matter, J.P. Morgan. And with that in mind, I want to thank you for listening. Look forward to chatting with you again at the end of next quarter. And if you need to get a hold of me at all, please give me a call on anything at all. Once again, thanks so much. Have a great summer.